Hello, everyone, and thank you all for joining today's webinar hosted by the Online Lending Policy Institute. And we are glad to have you all with us today. My name is Gilles Gade, and I'm the president and CEO of Cross River Bank, a New Jersey state chartered bank, FDIC insured, and that merges the trust and reliability of a community bank with the innovative offerings of a technology company. We have an incredible program scheduled for you today. And it is my great honor to introduce our very special guest, the chair of the FDIC, Jelena McWilliams. Under Chairman McWilliams' leadership, the FDIC has consistently fought for and advanced policies that promote financial inclusion, modernization, and consumer protection. These policies have reinforced a resilient financial system, and the agency continues to demonstrate its willingness to work with the industry. Events like this to ensure that they have the necessary tools to thrive under any condition. I can tell you from my own experience, working together with Chairman McWilliams has been extremely constructive and an absolute pleasure. She recognizes the changing and challenging nature of financial services, and together with her team, they've been engaged in a meaningful dialogue to ensure that regulatory oversight and compliance keeps pace with innovation. Today, we look forward to hearing more about recent regulatory efforts to modernize the financial system, as well as discussing what's in store for the future as the FDIC continues to promote responsible innovation throughout the industry. The chairman, thank you for taking the time to join us today, and more importantly, for your thoughtful leadership, especially during this unprecedented time. On a personal note, I look up to you, Chairman McWilliams, as a first-generation immigrant from Europe. Her English is far better than mine, that's for sure, and I truly aspire to match her accomplishments and impact on our industry and the community at large. Without further ado, I would like to introduce the Executive Director of the OLPI, and my dear friend, Professor Cornelius Hurley, who will be moderating today's discussion. Thank you all again for your participation, and I look forward to this.
Thank you, Gilles, and thank you for your kind words, and thank you for supporting OLPI. Both you and ProBank have been enormous supporters of this organization that has been in the forefront of thought leadership now for almost 5 or 6 years, I believe. I echo everything you said about our chairman and more. I first saw her at a conference, and I was so impressed. I was looking forward to meeting her, and here we are. So, but we're not in person. So, can I meet you with a fist bump, Chairman McWilliams?
You got it.
There we go. There we go. The next best thing. So what Gilles just said about your background, I'm sure the line from Hamilton that is my favorite is your favorite as well. It's when Hamilton and Lafayette meet on the battlefield at Yorktown, and they say, what do they say, Chairman McWilliams? They say, immigrants, we get the job done. And believe me, no chairman in my memory has gotten the job done in terms of fintech and inclusion and all of those good things than Chairman McWilliams, including events over the past week or 10 days. So I would like to hand it over to you, Jelena, right away for you to tell your personal story and what motivates you in the policy front. Your chops, as it were, in the industry are beyond dispute. Working as an attorney at the Fed, on the Hill, general counsel for a major regional bank holding company and bank. But what I think our audience really wants to hear is what your background and what motivates you to do the things you do now and going forward. And then we'll jump into some questions. So the floor is all yours. Thank you again.
Well, thank you so much, Professor Hurley. And with a wonderful introduction like that by you and Jill, I think I should just, press the end button and go home now. My favorite line from Hamilton, and this is actually, I like to think that this has to do with my background, is the $10 founding father without a father got a lot farther by working a lot harder, by being a lot smarter, by being a self-starter. And I would say that, frankly, Gilles knows the story, because when he first came to see me and I said, all right, we regulate your bank, but I want to learn about you. And he gave me a little bit of his background, and I shared mine. I came to the United States on my 18th birthday as an exchange student in high school for 1 year of high school, and I landed in Stockton, California with $500 to my name, and lived with an American host family for a year. And I was determined that if you can make it anywhere, if you can make it in the United States, that's the place to be. And so I came to the United States because I believe in the premise and the promise of this country. And maybe I watched too much Dallas and Dynasty when I was a child, but I believe that you can come from nothing and create something, and that you can basically realize your American dream. And so almost 30 years later, 29 years later, here I am as the chairman of the FDIC. So my $500 translated essentially into this many jobs later. But I'll tell you, my policy perspective and my life experience have truly shaped who I am at the FDIC. And here's what I had an opportunity when I got this job. I asked myself, I said, you have two choices. You can conform the position to you, or you can conform yourself to the position. And conforming myself to the position means that I would have to fit within the perimeters and the goalposts of this position. And I decided I'm just going to bring myself to the position and conform the position to me, because I believe that my experiences, some of which you mentioned, basically allow me a holistic view of the financial services. And frankly, had I just tried to mold myself to the position, I would not be speaking to you right now, because I don't think we would be talking about innovation in a positive light. I don't think we would be talking about fintechs as a positive development in the regulatory space. And I realized from when I was a lawyer early on in my career in Silicon Valley in the early 2000s, and then later on when I was a general counsel of a regional bank, I realized that technology and progress are inevitable. And the way we evolve, the system evolves, is by using technology. And so we can, on the regulatory side now, we can say, oh, innovation is complicated, it's risky, we don't know how to regulate it, therefore it's not good. Or we can say, listen, it's happening, and we're either to get on board and create a pathway for this innovation to take place with our financial institutions, or we are frankly going to miss out on this development. And innovation will happen. It's almost like water, when you fill up the glass, the jar with rocks, and the water finds a way around it, and you put sand and the water still finds a way around it. And so the truth of the matter is that we need to get on board with this innovation agenda. And for me at the FDIC, really what I'm hoping to accomplish, if I accomplish nothing else during my 5 years, and I have about 3 years left, it is that I'm going to move the agency forward as one of the foremost agencies in DC, regulatory agencies, as we look in innovation and how financial inclusion, frankly, can prosper through these partnerships between the banks and the fintechs.
Perfect. So let me set the table for how we're going to proceed here. We have about almost 18,000 people on this call right now. That would be remarkable if it were true, but it's not. But we do have many people on this call, and all of those people are going to have an opportunity to ask Chairman McWilliams questions, and they'll do that by sending an email, clicking the box on the bottom of your screen now. And my friend and colleague Marty Mitchell from ProBank is in a dark room in Louisville, Kentucky right now, and he's going to be reading all of your emails. And at the end of our conversation, some or most of them hopefully will be asked of the chairman. And the same holds true for the bonus session that we're going to have at the end after after Chairman McWilliams gets tired of us, she's going to hand us off to her 2 senior staff people who are working on extremely exciting initiatives, or at least I find them extremely exciting. One has to do with the certification process proposed, or at least eliciting comments and questions for fintech companies and models. And as we know, the partnerships and the models are driving the innovation in our industry, particularly as it relates to community banks, and also an exciting initiative having to do with the, for want of a better word, the demise of the call report. So we have, as I said, 2 senior individuals, Brandon Milhorn and Leonard Chanin, are going to be joined by Mark Franson of Chapman & Cutler for the bonus session at the end. That doesn't mean, Jelena, that we can't get into that during your presentation as well, because these are extremely important initiatives. So please send your questions along. So I thought my questions, I was dividing them into 2 parts as though it was a balance sheet. Assets on the first, and debt and liabilities and dividends and so on at the end. This creates the favorable false impression that I am well organized. So we don't have to keep to that format, but at least starting out, that's the way it is. So Chairman McWilliams, tell us just 2 or 3 things that the FDIC has done in this all-important moment that we call the COVID crisis. What would you consider the 2 or 3 most important initiatives that you have done? I know you've done a lot of things,
Sure.
both individually as an agency and collectively with the other agency, but if you could share that with us, that would be terrific.
Sure. So I would say that as soon as the pandemic was diagnosed, actually before it was even diagnosed as a pandemic, I've been monitoring what was going on in Asia and thinking that, you know what, we're an ocean away from this, but an ocean is not that big when you have, you know, hundreds of flights every day going back and forth, thousands in some cases. And so I started thinking about the 2008-2009 crisis, and I started thinking about the regulatory response back then. And I had the good fortune of being at the Federal Reserve, frankly, as a consumer protection lawyer in 2008 and 2009. And remember being almost kind of a whiplash with everything that was going on, trying to figure out what now. And this was at the time where you didn't have the CFPB, so each of the prudential banking agencies had a consumer protection division and the statutes within their jurisdictions on the consumer side. And so I started thinking, what do we need to do to make sure that we do not have the repeat of the 2008 and 9 crisis? And one of the things that came to my mind was we have to be proactive and we have to be fast, and we have to do a regulatory whack-a-mole without knowing where that mole is going to rear its head. And so we just started on the it's kind of anticipating what can happen down the road, what can happen tomorrow, what can happen 2 months from now. So one of the first things that we did was on the supervisory side, I basically urged our regional directors and examiners to show utmost flexibility in terms of both exam timing and scope, as well as general supervisory matters. So our regional offices reached out to their banks and said, do you need extra time? Do you need to reschedule your exams? And we did. We rescheduled some exams. Most of the banks said we would like to proceed as scheduled, but I told examiners it is absolutely paramount that for the immediate effect, we give them flexibility and have the banks dictate to us basically how they want this to proceed. We did all of our exams off-site, which frankly was one of those interesting things technologically. I was hoping to get to the point where we can do more off-site examination by year 3 or 4 of my tenure. And I was told all along, oh, the technology is such that we can't do this quickly. And lo and behold, the pandemic struck and we had baptism by fire, where we had to, like this, switch to offsite and using technology, and we did. Now, some of the exams end up being a little bit delayed because a lot of the banks do not have the technical capability, especially the smaller bank. But we had to do very quickly something that we anticipated would take about 2 years. So if there's a silver lining in all of this, I would take that as the silver lining. And then we started thinking on the regulatory side, what do we need to do, right? And one of the first things that we realized we had to do was Tell banks to work with their customers. They have got to work with their customers, because if they don't, if they're concerned, banks want to work with their customers. And that is the kind of the baseline. Banks want to work with their customers. They're in the business of working with their customers, right? Banks won't work with their customers on modifying these loans and working on forbearances if they don't think they're going to get a regulatory reprieve for doing so, and at least they won't get punished. So early on, we basically told banks, work with your borrowers, work on loan modifications. We told them, we worked with FASB, Financial Accounting Standards Board, to make sure that loans modified for the purposes of the pandemic that were performing as of the end of last year would not be classified as troubled debt restructuring, which was a big win, to tell you the truth, because now we knew that banks won't be concerned from the accounting treatment how to proceed with the loan modifications. We then worked with our fellow regulators, OCC and the Fed, to encourage banks to dip into their capital buffers. We excluded from the regulatory capital exposures related to the Paycheck Protection Program liquidity facility and the money market mutual fund liquidity facility at the Fed. We also took steps to mitigate the impact of these facilities on banks' FDIC insurance assessments. We delayed the effects of CECL adoption on regulatory capital. We, after the CARES Act, we lowered the community bank leverage ratio threshold to 8% for 2 years, with a gradual return to 9%. And I would say, when I think about what was like the third prong of all of this, for years now, we've been working, this was one of my pet peeves coming to the FDIC. I said, banks are not doing small dollar lending, and that's a problem. That's a problem because we have basically, because of our regulatory regime, we have minimized competition for consumers. And now consumers do not have as many choices as they would if we encourage banks to be in this space. But I know, as a former general counsel of a bank, when you have a bulletin from 2017 at the OCC, 2013 guidance from the FDIC, and SR letters, supervisory letters from the Fed, and a payday lending rule at the CFPB that's being held up in a court in Texas, this was a couple of years ago, you would be crazy to lend in this space because there's so much uncertainty. There is so much of unpredictability that as a former general counsel, I would say, don't do it. Don't do it. There's liability on every step of the way here. So after much work, we got together with the Fed and OCC, and NCUA joined us as well, to jointly release principles for small dollar lending on May 20th. And the idea here was to encourage banks to be in this space, to give them this guidance, to allow them basically to proceed with this. And then lastly, the OCC and the FDIC finalized the Madden rule, the so-called Madden rule fix. And I would say, when I look at the things that we have done, and I would probably put them in that order of importance, as we were looking to kind of ameliorate and anticipate the effects of the crises, and make sure that banks are able to lend and serve as a vehicle to recovery, and not have regulatory roadblocks on their path.
Yeah, so that's those are fantastic actions that you took, and I would be remiss if I didn't mention, since you mentioned PPP and small dollar lending. I hope Gilles is still on the call, because his bank has been a star in that area. They have originated something like 150,000 PPP loans, an average size of only $38,000, putting them in the top ranks of banks in the country, not the top ranks of community banks, but the top ranks of all banks. So yesterday we learned from the president that the worst is yet to come as far as COVID goes. And we may be looking at quarters, if not a year, if not more, of downturn, and some states and regions could be reclosing, not reopening. And we're all familiar with the term extend and pretend, and we're all familiar with the word foreclosure, and how those two words and phrases have negative connotations in the banking world, particularly among regulators. Have you at the agency, or either at the FDIC or collectively with your colleagues, been giving some thought to where do we go? TDR restructurings and all that relief that you gave and the CARES Act gave from FASB and so on is wonderful and necessary, and I applaud you for it. But it could be a long road. And we said at the beginning of this economic crisis that thank God the banks are well capitalized and liquid, but for one, I'm concerned, and I'd love to hear your comments, Jelena, on those issues. What does the future hold?
Sure. So if I had a crystal ball, I could tell you what the future holds, but I'm looking at this as kind of a one step at a time, and trying to anticipate, frankly, the next 3 steps, but not being able to tell you what the additional 3 steps beyond that would look like. And so one of the things that, like you mentioned, going into this crisis, banks were well capitalized. There was ample liquidity in the system, and I would like to believe they were well regulated as well. And so as we looked at this initial impact of the pandemic, it wasn't financial. This wasn't a financial crisis, right? This was a health crisis that forced states and localities to close down businesses. And as a result of those closures, the economy that was roaring and was going phenomenally well all of a sudden came to a halt. And so banks have been able to withstand that initial shock rather well. And so when we looked at the quarterly banking profile call report data from the first quarter of this year, we saw that banks were able to adjust pretty well and pretty quickly, right? And so as we look at the community banks in particular, they reported lower profits than a year ago. And that was primarily as a result of higher provisioning expenses. Nonetheless, their net operating revenues increased, their annual loan growth rate was strong, and asset quality metrics remained stable. And so despite the decrease in profitability at the end of the first quarter, bank capital and liquidity levels remained very strong, and asset quality metrics were stable. And frankly, the number of problem banks at the FDIC remained near historic lows. So all of those were positive indicators. Now, what we're aware of is that our first quarter QBP data, the call report data, captured about 3 to 4 weeks, about 3.5 weeks of the pandemic-related closures. So as we're looking at the second quarter data and then trying to prognosticate what to anticipate in Q3 and Q4, I have told multiple people, both policymakers on the Hill as well as fellow regulators and our examiners and supervisory folks, we are just going to have to exercise flexibility. So as we're looking at, the TDRs, as we're looking at how to proceed on a number of different initiatives that we did as an initial measure back in March and April, we will just have to assess the economy and the state of the banks at the time when we're making that decision, and be cognizant that we don't want the solution to be more painful than the. And so it's if I can give you any assurance, not knowing what we can anticipate in the next few months, it is that even if we find the vaccine relatively quickly, and even if we're able to get to the herd immunity, say in the next 9 months, right, which would be I think optimistic, there's usually 3 to 4 quarters at the very least that take for the economy to get back on its feet after a shocking event like this that was frankly not, you couldn't fathom this, you couldn't prognosticate this. And then it takes additional 3 to 4 quarters for the banks to be able to work through the problem loans and the impairments and people getting back to work, etc. So even if we were able to find a vaccine right now and get to the better place vis-a-vis the pandemic itself, we're looking at probably a 2-year lag on the economy and the impact on the banks. And so we have to be cognizant that this is not, a sprint. We're in a marathon, and on a regulatory side, we need to take all the steps we need to take to make sure that banks can help to this, and frankly help the borrowers, because that's really where we need to be focused on, helping the borrowers so that that loan that frankly can be modified now and not be a TDR, not be impaired, is not the same loan that didn't get modified, and then three months down the road we have a trouble debt.
So last month the Fed told the largest banks to forget about stock buybacks, and they capped the dividends on the largest banks because and then later those same banks provisioned tens and tens of billions of dollars for losses going forward. Do you foresee any signaling to the 3,000 banks that you have direct supervision over that they should do similar things, foregoing or limiting dividends?
So I'll tell you this, a couple of things on the dividends. Most of our banks, as you know, are small banks.
Right.
The larger will fall under the umbrella of some of the Fed guidance vis-a-vis their holding companies. And as we're looking at our small banks, frankly, we have supervisory tools if we're concerned to tell them to suspend dividends and to suspend share buybacks. Our examiners are very intimately involved with those banks, especially the banks where we have concerns about the dividends or buybacks. And unlike the big banks, most of the small banks are, especially to the extent that they're S corps, most of them are either privately held or they have a small number of investors in there. So we didn't want to do a blunt cut announcement as to do this or that. We're handling this on a bank by bank basis, depending on the size of the bank, depending on the condition of the bank, and whether or not we have regulatory concerns about that bank preserving capital. I will tell you this, the CEOs who are really careful and who are trying to forecast as well as they can with the information at hand right now are concerned about preserving capital, and they are initially on their own volition taking these steps that are necessary for them to be in a better capital position than not. Okay,
wonderful. So again, going back to the left side of the balance sheet as we were talking about, you mentioned Madden. Madden is not the NFL coach and TV commentator, but rather for some of our audience, it's a case out of the Second Circuit in New York, which said that a loan made by a bank that is valid at the time that it is made may potentially be unenforceable when that loan or pieces of that loan are sold to non-banks. And a companion issue to that is the issue of a true lender, which gets into whether the bank is using allowing its charter to be used and for some other purpose. And to your credit, you addressed that issue frontally, as did the OCC. The OCC was a two-step process. They addressed Madden, and then they addressed true lender from a regulatory perspective. You have addressed Madden from the valid when made perspective, and I assume you're going to be addressing the true lender issue as well. But comment, if you could, for a moment, whether you think this solves the issue or whether you think there is a congressional fix that needs to take place. Because after all, we're talking about a matter of contract law largely, not only secondarily a matter of bank regulation. But again, I applaud you for what you're doing on this issue.
Sure. So last month, which now seems like an eternity ago, we issued a final rule to clarify that the valid interest rate for a loan is determined when the loan is made and will not be affected by a subsequent sale, assignment, or other transfer of the loan. And you know what, all we did, we basically codified our long-standing FDIC guidance, which we had for about 20 years in place through this formal rulemaking, to provide the public with an opportunity to comment, because I'm one of my key things at the FDIC is transparency and making sure that we do everything in the public's eye. And a couple of things that we accomplished with this was to address the marketplace uncertainty regarding the enforceability of the interest rate of a loan agreement following a bank's assignment of the loan to a non-bank. And I thought, as a contract lawyer, I was a corporate lawyer, and a lot of my work was spent on different types of contracts. It was important to clarify what our position on this is, and to frankly put it, instead of having this guidance that we have had in place for 20 years, actually put it in a rule. So there's the roadmap. Here's how you do this. And frankly, a lot of people, including some folks on the Hill, misinterpreted our valid when made rulemaking based on that 20-year-old guidance to be the true lender issue, which we plan to address separately. As you mentioned, the OCC just proposed their fix a couple of days ago. OCC has different authorities than we, and so we are frankly currently going through the analysis of exactly how to proceed under the authorities, statutory authorities that we have. We'll take a look at the OCC comments that they received to see what kind of a feedback they're getting before we move forward. But it's certainly something that we want to make sure that there is some stability in the marketplace, because these are viable channels for consumers to get loans. And frankly, for people who don't believe in the securitization process, who don't believe in the sale of loans, I just have to say that, you know, these banks have to use these channels of free market to be able to function. And for supervisory principles, we actually want them to engage in the sale of loans, etc. And for safety and soundness. So there's an interest we have this that goes above and beyond just clarifying the uncertainty. And from the safety and soundness perspective, we need to have a viable secondary market for these loans, and we can't do that unless we provide a roadmap.
Right, and as you have pointed out on a number of occasions, from a receivership standpoint, you have to be able to liquidate the portfolio on the terms that are most advantageous to the deposit insurance fund.
Absolutely, we have a mandate to minimize losses to the deposit insurance fund.
Right. Yeah.
If the value of these loans is questioned because of the uncertainty in the marketplace, then that presents a problem for them, and frankly undermines our ability to deliver on the statutory obligation we have to minimize losses.
So am I safe in saying that there's no substantive difference between you and the acting comptroller on these two issues, valid when made and true lender?
Well, I would say on the issue that we finalized, which was valid when made, there were nuance differences, truly, you know, nano differences on that one, because our authorities on on the true lender are different. We will have to see where we end up.
Okay, good enough. So you may be constrained in commenting on industrial loan companies, but as you know, our constituents are very interested in industrial loan companies. Some see them as a marvelous competitive niche. Others see them as a device for regulatory arbitrage. And you have a rulemaking out on that proposal that it expired June 1. I imagine you're somewhat constrained as to what you can say about the outcome of that rulemaking, but within the bounds of what you can say, can you shed some light on your current thinking about industrial loan companies, just in a nutshell for us?
Sure. And because I'm the chairman, I can say what I want. No, I'm kidding. No. I've said many things publicly, and I'm comfortable speaking about this. It was one of the, frankly, stifling questions when I was asked in my confirmation hearing, you know, how do I feel about the industrial loan corporations or industrial loan banks? What I said is, like, I have no feelings. I have to follow the statute, right? So that's my job. And you know, Gilles will appreciate this as a first-generation immigrant, but I came from a system where government didn't always follow the laws. And so I want to be a regulator that if you give me the law, my job is to follow the law. And when you give me regulatory discretion, to exercise that regulatory discretion judiciously. And so we took a position that so long as Congress deems ILCs to be in the statute and they don't vote differently on the long-standing statute, our job is to take the applications, consider the applications on the merits that Congress gave us and our long-standing practice, and if the applicant is able to meet the requirements, the statutory requirements, which, by the way, they're requirements, and they're not requirements for an ILC, they're requirements for deposit insurance for the entity, and they're the same whether you're a bank or an ILC applying for it. And so we apply the same ones. So one thing that we have done in the past, and this is why we ended up having the rulemaking out in the proposal, is we would impose, since about the early 2000s, we imposed so-called CALMA, Capital and Liquidity Management Agreement, between the holdco and the ILC, the holding company, to make sure that the holding company stands behind the ILC, so that when we grant the deposit insurance to the ILC, that the holdco is basically there as the source of strength. And so the proposal that we issued back in March is focused on several key components of this, and it would require the parent company and the industrial bank to enter into an agreement, basically a contract, that would the parent company would consent to examination of itself and its subsidiaries, including the industrial bank or ILC, by the FDIC. They would submit the annual report to the FDIC and maintain records that are deemed necessary by us. They would commit to annual independent audits. They would, the ILC would basically limit the parent company's participation on the industrial bank's board to 25%. The ILC would commit to maintaining minimum capital and liquidity requirements. They would enter into a tax allocation agreement and also develop a contingency plan for recovery in the event of economic distress. So these are the things that we have had in place, frankly, for some time. Again, like the valid when made guidance, this was only through a guidance that we have implemented this on an ad hoc basis, and we put a proposal out to basically memorialize them and put them, codify them in our regulation, so that if companies are applying for ILC deposit insurance with us, then they know the rules of the road. Then you'll see this is a consistent theme by me, at least under my chairmanship. I want entities that come to us to know what to expect. And so this proposal was basically codifying what has been existing practice, but it wasn't codified before at the FDIC, which is requiring these CALMA agreements between the parent and the ILC to make sure that the ILC is protected and that the parent serves as the source of strength for the ILC.
Chairman McWilliams, it looks like maybe we've lost Con for a minute. So, oh, there we go. Now he's back.
You know, people usually run away when I talk about ILC, but I never had him disappear from the screen.
No, that was, I was afraid maybe he was taking a nap.
No, he was probably looking up a tricky question to ask on the source of strength, but okay.
Well, while Con's getting situated,
I don't know,
let me go ahead with one question that we've had submitted to us, if you don't mind.
Sure.
So it may not be quite fair, but the OCC put a letter out today about cryptocurrency. And just to read Acting Comptroller Brooks's words, he says, you know, this opinion clarifies banks can continue satisfying their customers' needs for safeguarding valuable assets, which today includes cryptocurrency. The question that we've gotten is, was this coordinated with you? Does it have an impact on the fund? You know, are you in agreement? I think basically the concern is does this have an impact on the FDIC's ability to fund, to protect?
Sure. And it's a new question, so it doesn't matter if it's fair or not. I certainly have thought about this. We have been in discussions with the OCC. We knew this was forthcoming. Acting Comptroller Brooks and I have a very good working relationship, and so to tell you the truth, I haven't looked. I have the printout here of what they just released, but I haven't really analyzed it from the perspective of the deposit insurance, other than would this apply? Would this be covered by our deposit insurance scheme? And our initial reaction is that it's a custodial asset. It's not a deposit per se. And so with that, there are limits on how much concern, frankly, we would have, because it's not an insurable asset.
Okay. No, I think that was a pretty good off-the-cuff answer. Con, do we have you back, sir?
Well, I hope so. Can you hear me?
There we go. Yeah.
Con, your question is so much nicer than Marty's.
No, I had to jump off. Tony Fauci was calling me for some medical advice, and it was more important. Sorry.
Now I'm really concerned.
Yeah. So I don't know what I missed exactly, but I was going to ask you about the issue of brokered deposits. Mm-hmm. As you said, you are the chairman, so you can say whatever you want. And you have said that you think that the best way to regulate troubled banks is through asset caps. And I tend to agree with you, rather than through brokered deposits. Excellent op-ed in the American Banker just today about a bank in Arkansas that funds itself with brokered deposits. Again, you have a rulemaking out in that area. Can you give us any guidance on where that's going?
So I can't really give you guidance on where that's going, because we're reviewing comments. And again, We want to be as transparent as possible. We produced and proposed this new framework for broker deposits, frankly, because that framework has not been revisited in a meaningful manner in 40 years. And the industry has changed. The way that banks look for deposits and attract deposits has changed. And yet our thinking about broker deposits has not really evolved with the technological changes and the changes in the industry. So back in December, we proposed this whole new, I would say, a brave new world of broker deposits. And frankly, trying to remove some of the stigma attached to broker deposits as hot money. The reason we have been thinking about the cap, putting a cap on a bank that is not well capitalized versus putting a prohibition on broker deposits is we really try to go to the crux of the issue. And the crux of the issue is that a bank that's not well capitalized, you're concerned about its sources of funding, because you don't want, if that bank fails in about 6 months, you want to be able to resolve that bank with the minimum losses to the insurance fund, right? And so, you know, we have this cap on broker deposits as a way of saying, hey, bank, don't go. Now you can't go and get broker deposits to basically fund your way out of this. But you know what? They can go out there and make bad loans. And yes, we have examiners who are monitoring this bank, but it may take us a month, 2 weeks, 3 weeks, maybe a month and a half to figure out that these are bad loans, right? Yeah. And so why put a stigma on one category of assets, which is frankly a viable source of funding for many banks, versus this bank that is now, you know, not well capitalized, and we should be concerned about its growth in general, because we don't know how they're going to fund themselves, right? And so that's how the thinking on the broker deposit framework came about. We're hoping to finalize. We're reviewing comments. We have received a few comments. We have extended the comment period date because we thought people were pressed a little bit with the pandemic, etc. And so we're hoping to finalize it by the end of the year, and come out with a new framework informed by the comments. And frankly, the only reason I'm not jumping into any conclusions on how we're going to proceed is because we have to work through all of the comment letters and have to kind of go with analysis on a pro and con of each comment letter before we are able to tell you where we think we're going to land. This is not
Understood.
You know,
Understood.
Received notion of where we should end. We propose something and let's see what the public says.
That understood. When I was a younger man, I used to summarize those comments for the Board of Governors in Washington, and
I did too. And when I left the Fed, because I had to review 4,000 comment letters on escrows, I was done.
Good. But speaking on about funding, here's an issue. Full disclosure, I'm a director of one of the federal home loan banks. But there's been an issue over the years. It's not so much an issue today where banks are flush with deposits, but it is an issue and will be an issue going forward. Your predecessors, all of them to my knowledge, say that the FDIC is agnostic as to advances from home loan banks, you know, secured advances from their local home loan banks, which for many banks is the secondary source of funding after deposits. And yet from time to time, not always, but from time to time, an eager examiner will come along and criticize a bank that takes advances from its home loan bank, of which it is a cooperative member, and say you're relying too much on wholesale funding. Can you clarify that once and for all for the banks and for the examiner cadre, that the FDIC is agnostic as to whether they fund themselves with deposits or borrowings from home loan banks?
So it's one of those, I would say, principles that is similar to how we approach dividends and buybacks. It is hard to give you a kind of an umbrella answer as to how we're looking at FHLB's funding for the banks. I would say it depends on the situation. Generally, we do not view particular types of funding as better or worse. And so FHLB's funding falls into that category. Examiners do monitor how banks are funding themselves, and heavy reliance on certain types of funding by certain banks could raise concerns. And usually these are banks that we would have other supervisory concerns about. So in those cases, if we see that they're just going to FHLB's for funding and they're heavily concentrated there, they're probably going to raise concerns for us. Now, again, not because it's FHLB's and not because it's, you know, that's the source of funding. But because we already have some concerns with this bank and we think that it's heavily concentrated in this one source of funding, flubs will impose haircuts to banks in weak financial conditions. And I would just say every situation is unique, and just like dividends and buybacks, we're going to take a holistic look at the bank. And if we have supervisory concerns already, that's probably where we're going to say, well, we don't like how much funding you're getting from flub. You need to diversify your sources of funding. But again, it's not because it's flub funding is bad. It's more so that the issues come from that bank and stem towards that stream of funding, not the funding itself.
Okay, so I'll take that as a yes.
You can take it. Said a whole thing.
Good. Okay, can we go to some very high-level questions now? And I don't think you're been prepared for these questions, but the FDIC board is an interagency entity, right? It has the CFPB, it has the OCC, it has you and two other directors. And then you have the FFIEC, the Examination Council, and then you have the Financial Stability Oversight Council, and then you have the Interagency FinTech Discussion Forum, and there may be many others that I'm leaving out. Here's where I'm going with this. From your opening remarks, I think you agree that technology and innovation is critical to the competitive nature of banks, individual, and our banking system in particular. And there are countries that are ahead of us when it comes to payments, for example, and open banking. What would you, I don't expect you to give a definitive answer, but we have, among all those agencies, we have the Financial Stability Oversight Council, of which you are a member, and I don't know, 10 or 12 others. Suppose through legislation, we reoriented that to be the Financial Stability and Technology Oversight Council. Recall that the FSOC, or the FSTOC, as it might be called, has the authority to require other agencies to do things, unlike FFIEC and unlike some of these other things that I mentioned. It actually has that emergency authority. And given that technically is so vital, that technology and innovation is so vital to the success of our industry, would you think that that is at least an issue worth considering? And oh, by the way, under FSOC, or FSTOC, is something called the OFR, which most people have never heard of, the Office of Financial Research. And while we're at it, why don't we rename that the Office of Financial and Innovation Research and give it a broader mission? Your thoughts?
So I am a big proponent of technology, and we created at the FDIC the Office of Financial Innovation, so-called FDI Tech, and some of the initiatives that I know you're going to talk with Brendan and Leonard about are coming from this office. So I do believe that more focus we have on technology and how to open up our regulatory framework and our regulatory regime at every agency to innovation and technology better. And here's why. And again, I mean, to your question, should the FSOC mandate it? I don't know that I have a view on that. I've never been, frankly, asked this question, but I do think that we, as the United States of America, stand to lose if we don't allow our companies to innovate, because innovation will happen. As I mentioned at the very beginning of this presentation today, innovation will happen whether we like it or not. And if we put such restrictions or do not provide a channel for innovation to flow in the United States, it will go elsewhere. It'll go to Singapore, it'll go to Hong Kong, it'll go to London, it'll go to, frankly, Africa, okay? You're looking at some of the things that are happening in Africa and some of the other developing countries more quickly because they're not bogged down by legacy systems and they're not bogged down by regulatory regimes that are kind of too complex for these new innovative solutions to prosper. And so as I look at that, I would encourage every single regulatory agency to think about innovation as a positive and not to be afraid of what innovation brings. Because frankly, if we're going to be at the forefront of the next revolution, the next new development, it's going to be because innovation brought us there. And as a regulatory agency, if I do nothing in my 5 years here, and I create a pathway for innovation not to be a dirty word in Washington, and at least in the bank regulatory circles, I will say I succeeded in a big part of what I came here to achieve. Really, one of the critical missions for me at the FDIC is to bring us to the forefront. We're never going to lead. Regulatory agencies are never going to lead. We're part of the government, and by its very nature, it's a slow move, framework here. But be open and don't look at innovation as a negative thing. And so, anytime I have an opportunity to tell that to the lawmakers, anytime I have an opportunity to tell that to my fellow regulators, I do. Frankly, I do. And I think we have an opportunity at the FDIC and today in Washington, you hear about all of these negative things happening in Washington, D.C., but I don't think people are really paying attention as to how much the winds have shifted. And we are open. FDIC is open for business as far as innovation is concerned. And some of the initiatives that you will talk about later would have been unimaginable just a few years ago. Yeah.
Well, then let's jump the gun a little bit before we get to that comment. But 2 days ago or 3 days ago, you put out a request for information on a terrific subject, which is the certification of fintechs and models. And if community banks in particular are going to survive, they're going to have to partner with fintech companies because they certainly don't have the capacity to develop those technology tools in-house. And in fact, they are already doing so. Can you tell us what drove you to this request for information and where you see it going?
Sure. So I'll tell you this. Early in my tenure at the FDIC, I went to Silicon Valley and San Francisco, and I met with a number of companies, probably some that are on this webinar today too. And one thing became clear to me: we don't regulate these companies directly. If we have any regulatory or supervisory jurisdiction over them, it's through our third-party service provider functions and jurisdiction. And so I went there with 3 questions specifically. One is, what are you doing? Second one is, are you partnering with banks? And how did you come up with the idea to do this, and why banks couldn't do that on their own, right? And it became clear to me that usually the way these ideas came about with these fintechs, and especially in the online marketplace lending space, came really because banks wouldn't enter that space. Not because banks couldn't, right? Some of these banks, especially the very large banks, they have billions of dollars. There's a bank out there, several of them, that have such large budgets for innovation and technology that if you put us and the OCC together and our annual budget, their budgets are still bigger, right? So it's not that they couldn't because they didn't have the money. They wouldn't because they were concerned what the regulators would say. So then a lot of this innovation happened outside of the banks because banks have to deal with legacy systems. They have to deal with regulatory issues. They have to deal with, again, with examiner in charge that may actually not be as fond of innovation as the head in Washington of the agency. And so it became clear to me as I was talking to these companies that they're partnering up with banks. They came up with a concept that's functional, that works well, that is going to provide credit to more people than banks could under the traditional underwriting standards or channels. And so then my next question was, how are you partnering up with banks? And inevitably, any one of those 20 plus companies that I met with said, well, we go through the first 10 or 50 steps that are the same with every single bank that we partner up with. And so then I thought, wouldn't it be better if we could kind of bundle those first 10 to 50 steps, right? And I'm using the numbers loosely. For a company, right? So that they get kind of like a good housekeeping seal of approval, right? And then when they go to the next bank, they start with step 51. Why? Because the first 50 steps have been certified. So the bank itself, the small bank, so say it's a bank that has 25 people on staff, right? so that that bank doesn't have to allocate 6 people to the first 50 steps, which could be hundreds of hours of those people time. And that's really how the idea for certification came about. You know, I came back to Washington and I looked at my chief of staff, Brandon, who you'll talk to later, and I said, get me a good housekeeping seal of approval certification program. And he said, what? And I said, go figure it out. Go figure. I want to have a program that basically gets us through this 55, first 50 steps, bundled up, seal, approved, go. And that's how it took a little while, but we were finally able to do what we just did, which is issue an RFI, soliciting information and figuring out how best to move forward with this concept.
Excellent. So the Biden economic plan, following up on your comments there, whether you realize it or not, you might have stepped into a political issue here. The Biden economic plan, as I understand it, calls for a federal agency to compete with the credit reporting agency, Equifax, Experian, TransUnion, so on. And it's not going anywhere, of course, until if and until he gets elected and certain other things fall in place. But it would be lodged within the CFPB. And as I said, it would basically compete with the other reporting agency. And as I read your request for information, the SSO that you're proposing could be a much tamer, a much less bureaucratic or threatening version of what Biden and his advisors are proposing. Has anybody brought that to your attention?
No, and thank God they didn't, because I try not to step on the third rail of politics, which is the political.
I don't blame you.
And I'll just say this, I don't know when that plan was done, but we've been thinking about our thing for probably close to 2 years since I came on board. And it was one of my early conversations that brought me to this idea of third-party certification, basically to cut through the bureaucratic morass that each of the onboarding processes entails with these banks. Yeah. Because those first 50 steps are pretty much the same. You know, it's what's your operating system, you know, what firewalls are you using, and you know, slightly more complex questions.
Well, I direct our audience to read your guide for fintechs and third parties that you published in February of this year, which is excellent, both from the bank standpoint and from the fintech standpoint. And then pick up this request for information that you published earlier this week, because I think you have triggered a debate that is going to go on for a long, long time. And I think I'm optimistic of it having a positive result.
Well, I certainly hope so. We generally do things hoping for a positive result. And certainly we're not trying to make a political statement or a political issue. These issues are American issues. And the issue of innovation and technology and whether or not we provide a pathway for our system, our United States regulatory system to allow innovation is frankly an American issue. And I would even say in some cases it's an issue of national security, if I may actually venture that far.
I agree with you. Last question, and then we'll hand it over to Marty and the audience. Two high-profile bankers, you may have heard of Jamie Dimon.
Oh, is this when I wink? If I've heard, I wink on one on the left eye, and if I haven't, you know, of course I could have. Yes.
And there's a fellow by the name of Brian Moynihan. Brian Moynihan is active with the World Economic Forum and the International Business Council, and Jamie Dimon is active with the Business Roundtable. In those separate capacities, they are pushing an agenda that asks us as citizens to revisit the supremacy of shareholder capitalism versus stakeholder capitalism, right? And we're in this era, this COVID era, where we say we're all in this together incessantly, and you are examining banks and looking at earnings and management and whatnot. And I was just wondering whether in the coffee room at the FDIC or around your dinner table even, or with other executives in the regulatory agencies, anybody's paying attention to this debate.
Well, sure. We always, I would say, we are cognizant of the debates like this. Many debates about social order and different issues that we're encountering. We're very highly cognizant of that. I wouldn't say it's a discussion at my dinner table because you see, my father grew up in communism, fought fascism and Nazism. Then, I'm sorry, he grew up in a kingdom, then fought fascism and Nazism. Then he lived in communism, didn't like it. Socialism didn't pan out so well for him, so he's now living in my house in Arlington, Virginia. And this is not a discussion I would frankly have with him for a number of reasons. But I'll tell you this: we're certainly looking at where things are moving. I think some of these issues are within the purview of the securities regulators. As a former securities lawyer, I know better than to opine on the interpretation of the law there. But I do think that social currents are changing, and we'll just have to see where we end up. My job is certainly to implement the laws as were written, and to the extent that there are new interpretations of the laws, and I will exercise my regulatory discretion very judiciously and proceed as Congress tells me to proceed.
It's an evolving issue. I just wanted to hear you say that it's on your radar too.
Oh, many things are on my radar, I would say, and certainly, the role of corporations, et cetera, is on there as well, and how we look at shareholders.
Okay. So Marty, do you want to take it from here, and I'll come back and say goodbye to the chairman after you're through with the questions?
Absolutely. And Chairman, we appreciate your time so much. We're already have kept you for an hour, but if we could just ask two questions. You talked about small dollar lending, and you struck a chord with folks that are watching, because we've had multiple questions about that. And it kind of rolls around, do you think the guidance will really encourage small community banks to do small dollar lending? But I'd like to say to you that as an FDIC examiner years ago, I had a community banker say to me, if you ever get the chance and you're in DC, tell them when we're gone and your grandmother needs $1,000 to buy fuel oil, where's she going to get it? And that stuck in my head all these years. And community banks still do a great amount of lending in their communities. But I know this is a concern. It's tough to make a loan that's not profitable, right? And so that's the crust of the question is, will there be guidance supportive of this type of lending?
Sure. So the guidance that we issued hopefully gives that, and the tone from Washington, at least from the FDIC and from me, I have talked about small dollar lending on so many occasions that I'm thinking it's going to say FDIC chairman, small dollar. And here's why. When I first came to the United States, I had $500, as I mentioned, to my name. And I realized pretty quickly that if I needed to get a loan, if I wanted to get a credit card, frankly, I couldn't. I was a ninja. I had no income, no job, no assets, and no credit score, speaking of credit scoring, right? And so I couldn't get an unsecured credit card. I had to send $300 in to get a secured credit card. And that was my kind of a window to being an American consumer, this $300 secured credit card, as I was frankly quite poor. And it led me later to believe that because I was able to get an unsecured credit card later on, I made on-time payments. Now my credit score is 800 plus. I was able to learn that if you're going to become a part of this society, in many ways, for better or for worse, you do it by being a savvy consumer, right? And so being a part of the system allows you to belong, right? And where am I going with this? Banks have two ways of attracting new customers, right? One is to take them from another bank, which is a costly prohibition. It can cost $300 to $600, in some cases even more, to acquire a customer because you have to offer them incentives. You don't know if they're going to be shopping for a new account in 6 months when your holding period expires. Or you can go after the people who are no longer or never have been a part of the banking system, right? People who either had a relationship with a bank, a checking account, that didn't work out of them because of either overdrafts or other issues, Or these are consumers that are new immigrants, people who never had an opportunity to become a part of the system because their parents are not a part of the system, and there's not a branch within a walking distance, right? And they don't have a car. And so as you're looking at that, you want these customers to come to a bank to create this partnership with a bank. And small dollar is it. These people need small dollar loans, right? And so that's why it was paramount to me that banks offer small dollar products, so that frankly, we're not in a place where consumers are unable to get the $1,000, grandmother who needs to pay for her heating oil, right? And that they're going to other sources which are not always as frankly regulated as well in the consumer space as our banks. And so somewhat selfishly, I would like this product at banks. I think it's going to offer up more competition for consumers. I think it's going to provide better pricing for consumers. And frankly, we can regulate it for consumer protection. Again, and what I've heard from the bankers is that even if it's not a profitable product, they're willing to do it if it's going to procure a new customer for them, because they're hoping to expand banking relationship with that person.
Oh, absolutely. I think that's an excellent point. And then if we just do one more question, and it kind of rolls the others all together. You mentioned about you're successful if innovation takes on and is no longer a bad word. I think you've done that. And the question is what's your vision when we talk about RegTech solutions or data-driven solutions from a regulatory perspective? Do you have a vision of what that looks like for the future? How that would, how that would feel to the bank and to the examiner, to the, the feet on the street examiner that's really your face out there to the community banks? When you picture it, do you see something? Is that something that you can describe?
Sure, I think of, Starship Enterprise, and I think of it and it appears in front of me, right? But baby steps in the meantime, and one of those baby steps is basically moving us to the place where our call report data is not archaic, meaning 4 months behind, right? To a place where we can at any point in time know what the state of the bank, a bank is, right? Or what the state of the banking industry is, kind of like a Bloomberg terminal for banks, right? Where I can just, at a press of the button, I can get a very specific type of information on a very specific entity or the whole industry, right? And that information is not right now available to us. Fed collects some form of data, OCC collects some form of data, we collect some form of data. These data streams are not always the same. Sometimes they're not, frankly, even talking to each other. And as we look at different banks, there's a better way to do this. And I think there's place for machine learning here. There's place for artificial intelligence. We have to harness them for the good. And yes, they're not perfect. And yes, there are issues we have to work through with them. But they're going to get us to the next stage. And that next stage is hopefully going to lead to the next stage. And hopefully at some point, probably not, well, definitely not during my tenure at the FDIC, but hopefully during my lifetime, we get to a place where, we have the Starship Enterprise of RegTech and LoopTech.
Oh, absolutely. It'll get there. Wonderful talking to you again. We appreciate all your time. Khan, I'll give it back to you. I'm starting to feel like we've kept the chairman too long.
No, thank you, Marty.
Jelena, we don't have 18,000 on the call, but we have many hundreds on the call. And I have to think that one of those many hundreds would be thrilled to work as the Chief Innovation Officer under a dynamic leader such as you. And if they aren't inspired by your presentation and remarks today, I don't know what would inspire them. So
please,
if they're interested,
can I make a pitch? Can I make a pitch? Can you give me? Okay, give me 15 seconds. All right, so we are looking for a Chief Innovation Officer, and I'm not looking just for a warm body with big thoughts. I'm looking for a doer. I want somebody who is thinking big, who's thinking the impossible is possible, and frankly, somebody who understands technology. Don't worry about regulatory framework. We can work with that. I have an agency of 6,000 regulators, supervisors, lawyers, and bank examiners, frankly, and we're looking for somebody who has big thoughts and is able to execute on this vision on getting us to Starship Enterprise. I want the foundation for Starship Enterprise to be built by this person. And so we've been looking, and frankly, I would love to have a dynamic, energetic person who has big vision and is able to execute and will help him or her along to get us to a place where innovation is actually a reality. We have made baby steps at the FDIC with this RFI and our certification process. But there's so much more we can do here. Brendan will talk about that in a second. And as I said in my op-ed in American Banker a few months ago, we can't offer you free coffee, maybe, but you know what? If I get the right person, I will give you free coffee.
Well, if you get the right person as a result of today's call, please let me know, and we can negotiate a very modest finder's fee.
Well, there's no finder's fee, but you know what? I can probably find one of those luggage tags that say FDIC, which will then make you look like a bank examiner on a bank closing. So it's probably not what you want. I'll just say.
No, that's good enough. That's good enough. We take swag. Anyway, it's an inspiration to talk to and to hear of all the initiatives that you have going on. And I know that we're going to be talking again, so I'm not going to say goodbye, but I'll say so long, I guess, for the moment. And I hope we can meet in person very, very soon, either in Washington or on lovely Cape Cod, where the internet isn't so great, but the weather is.
Well, at least you're not having a flash flood outside, so I would love to see you, and you know, it's a pleasure to be here with you. Thank you for being in this space. It's a truly important space. More dialogue and unbiased dialogue that we have in this space, better for everybody. Again, I firmly believe this is not a partisan issue. This is an American issue. And
Absolutely.
You know, I say all the time, I could have gone to any country in the world as an aspiring and ambitious young 18-year-old, and I chose the United States of America because it was and it has been a number-one country in so many ways. And I like to say, I'll be darned if on my watch we go to #2. So help me get me the innovation officer, and I will make sure that comment on our RFIs and our proposals to get us to a better place. And you have my commitment that I will keep an open mind, and I'll be shooting for stars.
I know you will. One last thing.
We're doing elbow. All right, elbow.
Okay, and thank you for making Leonard and Bernard available for us. That's going to be a lively discussion with Brendan.
Yeah, but knowing those two for sure, I may just have to send a cleanup crew after they're done. They're energetic, so enjoy them. They're not only my trusted advisors, but they're very good friends. So I think you'll enjoy.
Brandon's on the call already, I can see. And thank you again. Be
well.
Thank you.
Be safe.
Thank you.
And Mark Franson is going to do the chairing duties here. Mark is a senior partner at Chapman and Cutler, and he comes to us from an undisclosed location in suburban Chicago, where he's dodging bullets at the moment, I guess, right? Is that right?
Something like that, Con. Thank you.
Like that. And Mark, take it away.
Okay, Con, and good afternoon. I think we've got an exciting discussion here to come, as Con indicated. I am pleased to be a member of the Board of Governors of the Online Lending Policy Institute, as well as to head up the Bank Regulatory and Marketplace Lending Group at the financial services law firm of Chapman and Cutler. Those of us who are in the financial services industry certainly appreciate the efforts of the FDIC to promote the use of technology in the financial services space. And we are really very, very extremely pleased to have this follow-on conversation with two of the most senior officials at the FDIC relative to financial technology and innovation, and their, as we've talked about, their very recent proposal in this particular area. So I would first like to introduce Brandon Milhorn, who is the Chief of Staff to the Chairman, who we just heard. Brandon has an illustrious career, and if I went through all of those things, that would take up a lot of our time here. But he's been at the CIA at various positions in the United States Senate committees and senators, and was most recently Vice President of Governmental Relations at Raytheon Company. So welcome, Brandon. We also have Leonard Chanin, who is also a deputy to the chairman of the FDIC. providing advice in the consumer protection and innovative technology area. Leonard is well known in the consumer finance arena, has held positions over the year with the Federal Reserve Board, the CFPB, and most recently at Fifth Third Bank. So we appreciate both of you being with us today. And we also appreciate the fact that the FDIC was very cooperative in the timing of this webinar, because just 2 days ago, the FDIC put out this request for information about standard setting and voluntary certification, part of the effort of the FDIC to promote new technology, part of what the FDIC overall calls the FDI Tech initiative. So Brandon, I think I'll first start with you. Can you give us a little bit of insight upon what FDI Tech is generally, and then a little bit of background and summary about this RFI that came out on Monday, its purpose, intended outcomes, that type of thing. So take it away, Brandon.
Thank you very much, Mark. Appreciate that, and thank you for the introduction. You know, I've just realized it's never good to follow the chairman from a presentation standpoint, because I will always fall short of her eloquence. But so one of the things the chairman wanted to do, as she noted, one of her top priorities is innovation, both at the FDIC and across the financial services sector. And we wanted to highlight that from an organizational standpoint. So that's why we created FDI Tech about a year ago. And we're going to find that chief innovation officer hopefully today. They're sending me their resume very shortly. We'd be happy to see it, because we think this is an important component of the mission of the FDIC, particularly as you think about the scope of our supervised institutions. We supervise by far and away the most community banks, and these community banks come in all sorts of shapes and sizes. Some are very tech forward, you know, some are still you know, keeping their loan files in triplicate and store them in a vault. And we need to be able to encourage them and promote a more tech forward existence for them, not just because it's better for them from a competitive standpoint, because it allows them to reach new consumers with new and innovative products, because ultimately it's better for the FDIC from a supervisory standpoint, because if they're more technology focused, if they're using technology for their own operations, then we're able to use it for our supervisory and regulatory purposes more efficiently, more effectively, and that ultimately is the goal. So you know, sort of the rising tide of technology lifts all boats. That is the goal, and FDI Tech is the vehicle. The goal there is to set up a framework where we can do outreach to the private sector, whether it's banks or technology companies, to provide mechanisms for experimenting and thinking about new products, new innovations, and to run tech sprints and rapid prototyping events like we just started on our regulatory reporting side of the ledger. So that's FDI Tech in a nutshell. You know, we didn't create it within one of the existing divisions. We created it as a separate entity that reports to Leonard, which is basically one step removed from the chairman. It's going to be almost like a peer to our supervisory, our examination teams, our insurance teams. The goal being that they can have their own agenda under the rubric of the chairman, so that they a little bit more freedom of movement from a technology standpoint, sort of a DARPA or a skunk works at the FDIC.
Right. I appreciate your comments about always being a tough act to follow your boss. In fact, I told Con Hurley yesterday, I said, I sort of look at it as a parade in which you're sweeping up after the elephants. So
I'm the chief of staff. That's my job.
So I hope that though that we've got a lot of substance, and if you read the proposal, and I hope a lot of folks will read the RFI, it's really, from a regulatory perspective, I think only 17 pages, double spaced, so it's pretty succinct, unlike a lot of things that we see. But the proposal in a couple of places emphasizes the use of technology in credit models, particularly underwriting, and use of third-party providers. And it also then talks about consumer protection and access to credit. So, Leonard, I'm gonna sort of ask you, if people want to comment on this RFI, what if anything is the FDIC looking for in terms of addressing the consumer protection aspects of these issues? What's going to sort of be of interest to you folks?
Yeah. So really what this does, if you step back, we, as the chairman indicated, we've had discussions with a number of banks, small banks, medium-sized banks and the like, and fintech companies. And consistently, one of the things we heard was that it is incredibly burdensome and challenging and really redundant to onboard these parties. And the fintech companies are really those who are developing new technological solutions to allow more consumers to get credit, to allow credit to be dispersed more quickly, to be dispersed at lower cost, because they can devise solutions that many banks are simply unable to afford and unable to implement at this time. So we look forward to people getting comments on kind of the structure, if you will, that we've set forth in the proposal. Really, on the consumer side, the issues are what we want to do or propose to do in terms of getting comments is to set up this body, which would be, as we can talk about, not a government-run body. It would be a standard-setting body, certification body, run by a number of participants, some government officials, some industry participants, some academics, and the like. And what that would do is to certify these third parties, if they build models, if they want to onboard, that their models, if used, of course, properly, will comply with applicable laws, consumer protection laws, safety and soundness. So the question I think that's going to come in the consumer space is, well, how can we be comfortable that the bank itself is not testing these models, that the certification process is going to ensure compliance with those laws? And I think it's one, how are those standards going to be set? Who's going to set the standards? How are you going to ensure that the third party complies with those standards, not only initially, but on an ongoing basis? If they change the models because they use, let's say, new data, alternative data, what process is going to be in place to ensure that if banks use those new models or revised models, that those comply with fair lending laws, privacy laws, and the like? So I think those are going to be the core consumer questions, is giving banks a comfort level that they can rely on these third parties without, if you will, starting from scratch with each new change to a model, with each new permutation on whether it's underwriting models or other fraud models and the like. I think those are really going to be the consumer issues to ensure that, the banks can rely on these third parties in compliance with those laws.
So I know the proposal references both this SSO, this standard setting organization, and then it also talks about a voluntary certification process. So what's the difference between those two? I mean, are they mutually exclusive? Are they alternatives? How are you all viewing that?
So the way of standard setting, there are lots of different models for standard setting. One of the things that, one of the key components of the RFI is that public-private partnership to create standards. Now, we're not looking at mandatory standards. So, a lot of areas where you have standard setting, these are mandatory standards that you have to comply with. Think about the FDA context, where there are certain things you have to do. You have to submit to the labs, and the labs will verify your work, and that's sort of more of a mandatory process. What our RFI is looking for comments on is that a voluntary process for certification. So the public-private standard setting organization would create the standards. Then there'd be a layer of certifying organizations underneath the SSO that were familiar with the standards, had expertise in conducting reviews of technology, conducting due diligence on third parties that met the standards to be a certifying organization for the SSO. And technology companies would submit their technology or themselves for review by the certifying organization, which would then tell them whether they get their certificate or not. And once certified, banks could then rely to some degree on that certificate for purposes of onboarding and due diligence. You know, all the banks are still going to have to manage the ongoing relationship with the third parties. As the chairman said, from step 51 on, the bank's going to have to be responsible. But up to step 50, we think we can provide some reliance, something that the banks can rely on to bring that technology on board. You know, it's getting rid of that regulatory and operational uncertainty, that barrier to entry that causes a lot of community banks to say, you know, I'm not going to do that. We're just going to go the old route. So if we can knock down some of those costs, and honestly, if we can make it more cost effective for technology companies to come into this space, because if I'm a technology company and I've got a innovative way to get credit to low and moderate income consumers, and I want to take that to a community bank and let them use that model, well, I've got to onboard differently at every single community bank. And that's a cost not only for the institution, but also for the technology company. So if we can eliminate that duplication, streamline that onboarding process, we think we can make a more dynamic, tech-friendly environment for not only the technology companies, but also for the banks that want to onboard them. So that's the way the SSO, the standard setting organization, and then the certifying organizations would work in the construct.
So it really sort of gives them a leg up in the due diligence process, if you will, on getting new and innovative solutions into the bank.
Yeah.
Right.
Let me mention just one other thing that Brandon alluded to, and that is this would be voluntary. That is, banks would not be required to use this to onboard third parties. They could go through, if you will, the traditional process, and third parties likewise would not be required to use the SOS or the certification process. They could go through, if you will, the normal process. But to Brandon's point, we think this will streamline and make far more efficient this process for both banks and third parties. But again, it would be their choice as to whether they want to use or go through this process.
That's right.
And I know we're all lawyers here, so the lawyer devil's advocate in me is saying, well, the FDIC already has guidance out there on vendor management and third-party relationships and risk management and all that. How is this standard process going to work into that, or will it replace it, or sort of what's the impact with these prior issuances? And I know you briefly addressed it in the RFI, but I think particularly bankers and fintechs here would be sort of interested in that.
Yeah, I mean, look, there's always going to be requirements for due diligence when you're onboarding third parties, when you're integrating new technology. Our question is, the question the RFI tries to ask is, can we streamline and eliminate some of the duplication that occurs in the market? That our guidance on will undoubtedly change. If we ultimately put this construct in place, our guidance on third-party onboarding will necessarily have to change to accommodate that new process. But it will also stay in place. As Leonard said, a bank doesn't have to use the third party that's been certified. They can have their own procedures. And for a bank that decides it's in their best interest to continue that way, they're going to still have to comply with that guidance. And so, it is not just FDIC guidance that's out there on this. There are lots of standards on privacy, on information sharing, on cyber protections that the standard setting organization will have to think about and think about how it wants to incorporate those pre-existing standards as it creates a framework for the certifying organizations to do reviews.
I think one of the things, Mark, we hope this will lead to is really that we as an examining agency, that is a supervisory agency, will not have to go into every bank and look at every third party they onboard and look at, kind of look for the same criteria and standards and so forth for every institution. That is, if a party chooses to go through this process, a bank as well as a third party, that we can rely on the certification process and say, fine, you have onboarded this party. We don't need to look at steps 1 through 40. What we will have to do, as Brandon mentioned, is how you've implemented it. So if you get a model from a third party, to make sure that you've implemented it appropriately, because that is something that the certification can't control because it's out of everyone's hands. So, there will certainly be steps that as a supervisory agency we'll have to look at, but one of the goals from the supervisory function is that we'll be able to forego having to go through each and all of those steps of analysis and can rely on that certification process for many of the elements that we currently look at today.
Yeah. And as the chairman noted, there's only so much we can do for third-party service providers under our existing authorities. But if our standards, that we've worked with stakeholders to develop, if other third parties are coming in to meet those standards, to me that's without from a regulatory standpoint, having Washington and the FDIC come in and do this, it's a way for the industry to police itself to standards that the FDIC and other regulators who participate in the standard setting organization support. So that to me is a win from a supervisory standpoint as well.
And it's clear that the RFI is geared toward a lot of the smaller community banks, of course, which are also the banks that work with the fintechs largely in this day and age so far. So that's probably a real plus in that regard. Do you see though this expanding beyond just the FDIC supervised banks to the Federal Reserve banks or the OCC banks, or is there any collaboration sort of involved in this, or how are you viewing that?
Yeah, we're talking to other regulators about the RFI as well. I think we all want to see what comments come in. There's always it's always better for all the regulators to work together on issues. So if ultimately they decide they want to participate, I think we'd welcome that. Not just at the federal level, but potentially at the state level as well.
And I would also just like to remind the audience that there is a question box on your screen, or there should be, so that if you want to ask questions of Brandon or Leonard, feel free to write them in, and Marty will take a look at those and field them for us in a couple of minutes here. I want to sort of go maybe a little more granular into the response to the RFI itself. And if you go through it, it poses 26 different questions. Presumably not all of those have to be answered by commentators. You've got a 60-day window from the time it's published in the Fed Register to make comments on that. Do you have any suggestions for folks who might want to make comments to you, describe the process in any more particularity? What might you be looking for? What can they do to sort of get your attention to sort of make their points to you?
Well, I mean, all the questions are important, but all commenters don't have to answer all the questions, that's for sure. Personally, I want to understand what sort of regulatory compliance protections, what degree of safe harbor would commenters be would need to receive for this to be useful for them. And then as we get farther in, are there any other legal impediments that maybe we didn't think about that we're going to have to overcome if we move forward with the construct? The beauty, I think, of the standard setting being a public-private partnership is the stakeholders will also define the priorities, where they want to start, what issues they need to tackle, how they want to move forward, and to understand what type of guidance they would need from a standard setting organization. That's another area I think I'm interested in. Leonard, how about you?
Yeah, a couple of thoughts. One, at a very high level, kind of a 20,000 foot view of things. Will this work? And that is, do people think it's worth, the time, not only of the FDIC, but of all the participants to engage in this activity? And that goes to kind of Brandon's point. At the end of the day, will people use it? Will there be enough comfort that either from, kind of a supervisory examiner context, that is, they're comfortable that the examiners will use this, certification. Is there comfort in that? And will people use this? Is this a model that they think has promise? Because it's not really out there in any way in the financial services arena. And then secondly, to Brandon's point, is what are some of the specifics, kind of granular issues? We asked a lot of questions. People do not have to answer all those questions. Are there specific questions they feel, aren't clear enough in terms of where this would head? Are there other things that we did not raise, and I'm sure there are, that people are concerned about, or suggestions and the like? So I think it's pretty wide open, but kind of at a very high level, and then granularly, kind of what are people's concerns about this if it moves forward?
And it's certainly it's very innovative. It's very creative. But is there any concern about people saying, well, where does the FDIC get the authority to do that? Can they do something like this? Where is it in the law or regulation? I mean, that's how our regulatory blinders are on, that we sort of look at, and yet this is sort of like a whole new era. So any concerns on that? Or
well, we look pretty carefully at our authorities and ability to kind of move forward on this. One, this is an RFI, so it's not a proposed rule. But I think at this point, we're comfortable, certainly at this stage, with soliciting comment on it and with the possibility of moving forward in terms of our authorities.
And that actually is a good lead into sort of, we've got this 60-day comment period. What happens after the comment period? And of course, as always, is important, particularly in technology and fintech. How long is that going to be? Any surmises on any of that?
So I sent an email to one of the people working on it. The comment period ends, I think, toward the end of September. I think it's been published in the Federal Register. And I asked him, I said, so you think, I was joking, of course, I said, you think we'll be ready to publish a proposal by Halloween? And his response was, yes, trick or treat. So I think really we'll have to look at the comments, and we hope to get a lot of comments and a lot of very good, thorough analysis of it. We are eager to move forward, as quickly as we can, but there are going to be a lot of issues we have to look at and think about fairly carefully. So I don't know that we have a specific time frame. It really just depends on how comfortable we are moving forward and the like.
Yeah, I think that's right.
So we've talked a lot about this standards thing, but we know there are other things going on at the FDIC as well. For example, you're running a little competition to get a new call report format. So tell us a little bit about that if you can, Brandon.
Well, apparently we're building the Starship Enterprise, which I didn't know until a few minutes ago. That may take more than 180 days. No, but one of the my background is not financial services. My background is intelligence and homeland security. And the interesting thing that it struck me when I got to the FDIC was how time dependent our supervisory model was. It was really point in time supervision. We get a call report every quarter. We do an exam every year. And it struck me that looked a lot like how we used to handle cybersecurity when I worked on those issues in intelligence and defense. You'd get an annual report, you'd see where your risks were, and then you'd go but what you didn't realize is those risks were growing the whole year while you're writing your report. And so what we're trying to get to with the rapid prototyping competition is it's answer a question of, can we get to a point where we're getting more granular data on important financial health indicators from institutions, or and also, because of the granularity of that data, get some additional insight into challenges that we're facing across the financial sector. This is not going to, the rapid prototyping competition is something that's been used by other government agencies to very good effect. And unlike most, normal procurements, you don't get 1,000 requirements that you have to meet. What you get is a challenge question. And that challenge question in this case is, can you take information in whatever structure, whatever form, bring it in, run analytics against it, and then and add value and make sure data quality is good. And so that's the scope of the challenge. And so we've brought in a number of providers from, whether it's on the financial services side of the ledger, big data firms, cloud providers, the AIML experts, and giving them that question, and they come back and offer solutions. And then you can take the best of breed from those solutions and say, okay, in 90 days, I want you to produce a demo. And then you look at those demos, and based on the demos, you say, okay, in another 90 days, I want you to produce a prototype. And so from the challenge question to the prototype is 180 days. And hopefully at the end of that, you've got something that you can put into production, or you learn lessons that direct you in another route for another tech sprint, or another sort of a different way of doing government procurement. But it takes the knowledge and expertise that's out there in the private sector, tries to bring it in and say, in a competitive environment, what would you do? How would you fix this challenge? I'm pretty excited about it. It's been used effectively at other agencies. I'm not going to get rid of the call report in 180 days. First of all, I can't. It's statutory. It'd take congressional action. But the chairman said, if you looked at her op-ed, this is going to take years, maybe even beyond her tenure. But if we can start making progress, if we can lay the foundation for the Starship enterprise, then we'll be well on our way. It's a question that I ask supervisors all the time. Our supervisory model in many ways looks like 1933, right? Quarterly recall reports, annual reviews. Now, we've done a lot from a technology standpoint in those years to automate, to get better, to get more granular. We get good data from larger banks. We don't have a 1933 supervisory system. But if the FDIC was created today, what would our supervisory system look like? That's the question. And how can we use technology to get there? And from my perspective, the RFI and the rapid prototyping competition sort of walk hand in hand, because if we can get our tech, if we can get our banks operating more effectively using technology, then we're able to use supervisory technology on our side. And again, that rising tech tide lifts both boats.
I know your website says that data is the new capital. And I guess maybe from a bank perspective, that's true. From your perspective, I guess it's data is the new supervision, right? I mean, it's going to give you much better information, faster information, so you can get ahead of it rather than always looking at things in arrears. And I think that's a lot of the focus of all of this that we've been talking about.
Yeah, we're never going to get away from the human component of supervision and examinations. That's incredibly important. The ability to interact, to work with banks face to face and understand the challenges they're facing, to hear from them, how they're explaining their business model. But if we can make that more efficient, not only for our banks, but for our supervisors as well, then we can reduce the complexity and the costs associated with our supervision. And it could introduce new ways of doing regulation and thinking about regulation. It all starts with asking fundamental questions about, where can I get this data and what can I do with it when I get it?
So before we go to any audience questions, is there any other thing that you'd like to just say before we see if anyone has any questions for you?
Leonard?
Nothing from me, thank you.
Okay, then Marty, if you're still around there, let us know if there's any questions here.
Yeah. Thanks, gentlemen. It's nice that you were able to be with us and that you've stayed this long. The primary question, kind of rolling them together that would fit to what you've been talking about, is, and the chairman alluded to it, of community bank concerns of partnering with a fintech, just that unknown. It's really not an unknown. I mean, their worry most of the time is that it's going to lower their compliance rating. It's going to affect it somehow. And so the question that's come through is, with the certification program, is it going to be something where, the FDIC has somehow taken responsibility for this third-party management, this third-party due diligence? I know that that's not really the route you're going. It sounds to me it's more like, under their certifications of veteran status for small businesses, that type of thing, where there's industry standard and the government standard and different ways of certifying. But that's a logical concern, right? It was this certification taking it down the path to where the bank is going to have to rely on some outsider to say you're good with having this relationship. Yeah. And at some point, an examiner finds something wrong, and the bank's going to take the hit for it. I kind of rambled there, but that's kind of pulling 4 or 5 different questions together. That's kind of the gist of what they're asking.
So I guess the first thing I'd say is, this is voluntary. Whether a tech company wants to get a certification, that's voluntary. Whether they're willing to do that and subject themselves to that process, that's their call. Whether a bank decides to follow that certification or use their own process, completely up to them. I don't see this as an outgrowth of the FDIC. I see the construct that we've put out as more of a public-private partnership that has a certifying organization layer underneath the SSO that does this, not the FDIC. I think the FDIC can look at the standards, can work in the SSO on the standards, can set standards for how you become a certifying organization through the SSO by participating with other stakeholders. But I don't see the certification process as an outgrowth of the FDIC. On the other hand, we would want to find ways to respect that certification in the construct of our supervision, but we feel like we can do that because we participated in the process of setting the standard and in certifying the COs. I also think that also provides us with a mechanism, maybe a more effective mechanism for sharing any derogatory information we get on a technology or a provider in the context of our normal supervision of institutions. So we could go back to that if it's a certified provider, we'd be able to go back to that certifying organization and say, hey, you might want to take another look at this entity. But again, whether and how a bank decides to use the certification process would be completely up to them.
Yeah, the other thing I'd add to that is there will be some activities that the certification process can't address. Like, let's say you get a third party to do marketing for you. There's no way that a certification can address that because it's going to be specific to the institution, its needs, its audience, and the like. But what we hope to accomplish at the end of this, we hope, is that we will be able to rely on the certification for onboarding and certain processes that the bank today has to do itself and then kind of share with examiners and the like. At some point, as we kind of indicated, at some point in the process, when the bank implements a model or implements something, the third party the bank is going to be in control of some of those aspects, and then any certification presumably doesn't apply to the kind of from A to Z of the activities of the bank, but it's to try and get through, you know, A through M or whatever activities the bank gets the third party to do on their behalf, whether it's building a model or something else. So it's to really shortcut that process so that we can rely on that and not have to spend time looking at each bank and every third party separately and do that analysis.
Yeah.
Absolutely. The other part of that someone asked was, are there examples outside of our country maybe where you've seen this work? But I think there's examples in our country, just not in financial services. It's in
Yeah, so Underwriters Laboratory is probably a great example. There are lots of standard setting, public-private standard setting organizations that work through ANSI to come up with standards. I mean, at the end of the day, the good housekeeping seal of approval, even though that's not, you know, a federal program, is a model that you know, we want to think about and consider in this context.
Okay. And you mentioned the other federal agencies. Is the Conference of State Bank Supervisors, CSBS, would that be somebody who would be involved in this in the future if it goes forward?
If we decided to move forward, we'd welcome the participation of other regulators, including the states.
Right. Okay. Wonderful. See, Professor Hurley has rejoined us. We're actually overtime, which is wonderful. It's great that you kept this going. And we still have a significant number of attendees. So, but with that, I think that kind of wraps up our questions. Really appreciate your participation, everyone's participation. And I'll drop off and leave it to you, Professor, and Mark to close us out.
Great. Thanks, Marty, and thanks to ProBank on this. Thanks to our audience, but most importantly, thanks to you, Brandon. Thanks to you, Leonard. That's some great insight. I hope people will read the RFI. I hope they'll not only take it seriously, but provide you with thoughtful comments on that. And again, our thanks to the FDIC for promoting innovation. And in our organization, we always let Con have the last word. So, Con, back to you.
Yeah, I wish. So I have a very quick question for Leonard and then a challenge for our audience. The quick question for Leonard is, I'm a 5-rated bank and I'm basically insolvent, but going on your statement that data is new capital, I can say to you, well, I have all of this data over here, so don't close me.
No.
Well, I guess next time we won't give the professor the last word. I don't think it'll work quite that way.
Yeah, that's not going to affect your, that doesn't go to tier 1.
But the challenge, what is it, 26 questions?
Yes.
So.
Yeah, and they're all meaningful. We can't answer them all. My challenge to our audience today is, if you, we already obviously haven't thought through, OLPI hasn't, exactly what we're going to do about your proposal. But I think we would be influenced if a significant number or some of the audience today wrote to us and said, gee, we would like to participate in that RFI. So I'll give you my email address. I'll act as the clearinghouse for that if anybody is interested. It's basically ckhurley at bu.edu. We would love to hear from many, or as many of you as would like to dive in and help Leonard and Brandon out in this monster that they've created. A very good monster, I might add. Mark,
Monster Inc.
Thank you for your indulgence. Thank you for your time. Thank you for your service. Thank you for your contributions to the industry, our industry. And I hope we, perhaps when you get your comments in and you've digested them and we've had a chance to look at them, maybe we can do this again and share some thoughts and reactions. What do you say to that?
That'd be great.
That's a date. So to all of you.
Yeah, that's right.
Stay well and wear your mask.
Thank you.
Right.
Thank you.